Today, we are tearing into a really fascinating story from this last earnings season. We're talking about IZEA Worldwide's second quarter report. And let me tell you, it managed to be a massive historic win and, at the same time, a huge red flag for investors.
And that right there, that's the central mystery we're unpacking. The company hits this incredible milestone, something shareholders have been dreaming of for years, and the market just punishes them for it. So what in the world happened? Let's break it all down. All right, so first up, let's talk about the banner news, the headline that actually sent the stock flying higher at first. Because, on the surface, this looked like a picture-perfect earnings beat. I mean, look at this turnaround. It is just dramatic. IZEA went from a $2.2 million loss just a year ago to a $1.2 million profit. And this wasn't just a profitable quarter. This was the first time in company history that the profit was driven by their actual day-to-day operations. That is a massive, massive achievement. So, that bottom line, what did it mean for shareholders? Well, it translated into a solid 7 cents per share in GAAP earnings. For a smaller company that's been chasing profitability for so long, putting a positive number like this on the board is just a huge psychological and, of course, financial win.
And it wasn't just the profit, right? The company's financial health looked better pretty much across the board. Revenue held steady, which is actually really impressive given the changes they were making. Adjusted EBITDA saw this incredible positive swing of over $3.5 million. And get this, the balance sheet is pristine. We're talking over $50 million in cash and investments and absolutely zero debt. That gives them some serious flexibility. So, you have to be asking, how did they pull this off? Well, this wasn't some sudden stroke of luck. Nope. This profit was engineered. It was the result of a deliberate, and I'm sure at times pretty painful, strategic shift that they kicked off late last year. Yeah, and on the earnings call, the CEO, Patrick Venetui, he was super clear about this. He really hammered home that these changes aren't just temporary belt-tightening. This is a fundamental redesign of how IZEA operates, all aimed at building a company that can be profitable for the long haul. And how they do it? They took a scalpel to their costs. Total expenses were down almost 30% year over year. And the biggest driver of that? A staggering 70% drop in sales and marketing costs. Basically, they hit pause on a few initiatives and got a lot more targeted with their spending. And this gets to the key point. It wasn't just about spending less money, it was about spending it smarter. IZEA made a conscious choice to stop chasing every small, low-margin project and instead poured their energy into landing bigger, more profitable, recurring deals. It's a classic quality over quantity play. Okay, so a profitable present is fantastic, but we all know the market invests based on the future. And there was one key forward-looking number in this report that raised a major, major red flag for investors. And here's the problem child right here. Managed services bookings. Now, this is the number that represents new contracts. It's the best crystal ball we have for future revenue. Well, it basically fell off a cliff. It dropped from over $10 million last year to just $5.6 million. A nearly 50% decline like that? Yeah, that's going to cast a pretty dark shadow over any good news. Now, of course, management had an explanation ready to go. They broke it down into 3 parts. First, they said about a third of that drop was just a simple timing issue with a big client deal. Second, part of it was a direct result of their strategy, intentionally ignoring those smaller deals. And finally, they pointed to the broader economy, saying some clients are getting nervous and hitting pause on marketing spend because of economic and tariff worries. So you've got this historic profit on one hand, and a really worrying drop in a key future indicator on the other. How in the world did investors process this completely contradictory story? Well, at first the market just reacted to the headline. When that press release hit before the conference call, all anyone saw was first profitable quarter. So the trading algorithms and the headline readers all jumped in, and bam, the stock shot up almost 3.5%. But then came the earnings call. As soon as management started talking about that bookings number and the analyst questions started digging in, all that optimism just evaporated. The very next day, the stock closed down over 6%, completely wiping out the previous day's gains and then some. So what happened here is the market performed this classic risk assessment in real time. It looked right past those celebratory Q2 numbers, heard the uncertainty about future growth, and decided, you know what, we're going to price that risk in, and we're going to do it right now. So let's put it all together. from an analyst's perspective, what does this big strategic pivot actually mean for IZEA moving forward? Here's our take. Okay, so we're rating the stock market perform. Look, the pivot to profitability is a huge structural win. That's real. But the market has already moved on. This is a classic show me story now. The question isn't can you be profitable, it's can you grow profitably. For Q3, we expect them to stay in the black, but the stock will probably just trade sideways until there's clear proof that bookings are recovering. That is the number one thing to watch for in the second half of the year.
So IZEA has successfully recalibrated its entire business model. The hard part is done. Now they have to prove that this new, leaner IZEA can also be a real growth engine. And as you think about that, please remember, this analysis is for informational purposes only. It is not financial advice.